Everything you see is a lie, but the lie is so profitable that no one wants to wake up. We are living through the greatest disconnect in the history of human commerce. While you struggle with the rising cost of survival, the stock market is celebrating. It is hitting all-time highs as the foundation of the global economy turns to sand. You are told this is a recovery. You are told the soft landing is here. The truth is much darker. The market isn't climbing because things are getting better. It's climbing because the system is being sacrificed to keep the illusion alive. The delay is the trap. This is the great paradox. We are witnessing a $66 trillion cathedral built on a $30 trillion swamp. To understand how we got here, you have to look at the Buffett indicator. It is the cold, hard ratio of stock market value to the total size of the economy. Historically, a 100% ratio meant fair value. In the dot-com crash of 2000, we screamed in terror when it hit 115%. Today, we are at 220%. We have doubled the height of the most famous bubble in history. This is an unprecedented detachment from the soil. We are no longer investing in companies, we are speculating on the speed of a printing press. You are paying hundreds of dollars today for the mere promise of a single dollar of profit a decade from now. This isn't finance. It's a secular religion based on the hope that gravity has been repealed. Mathematics is the ultimate judge. Why hasn't the floor vanished? Enter the Cantillon effect, the most successful heist in history. Money doesn't fall from the sky like rain. It flows from a central source like a river. When the government creates trillions out of thin air, that new money hits the hands of the elite and the banks first. They spend it while it still has its full purchasing power. By the time it trickles down to your grocery bill, the currency is diluted and dead. Inflation is a feature, not a bug. It is a mechanism to transfer the wealth of the laborer to the owner of the debt. The market is being fed fiscal gasoline while the middle class is left to breathe the fumes. This is why the villain of this story isn't a person, it's an incentive. The state cannot afford to let the market fail, because the market is the only thing masking the bankruptcy of the state. The second hidden force is the passive engine. This is the mechanical rot. Over 50% of the market is now controlled by index funds, automated scripts that buy stocks simply because they exist. These algorithms don't check balance sheets. They don't care about leadership. They blindly pump the largest names, creating a feedback loop where the big get bigger purely because they are big. This has destroyed price discovery. The market is no longer a mirror of reality. It is a hall of mirrors. But there is a fatal flaw in the code. These algorithms have no reverse gear. In a healthy market, if a stock becomes too expensive, humans sell it. In a passive market, as long as people keep contributing to their 401ks, the machine keeps buying, regardless of price. When the first major domino falls, the passive engine is legally obligated to sell. It must sell the largest stocks first to maintain its ratios. This creates a liquidity hole. The very pillars holding the market, a magnificent tech giants, will become the primary drivers of the crash. The system is wired to self-destruct at the speed of light. Then, we have the shadow banking trap. After the 2008 collapse, the world demanded safety. The big banks were forced to move their risks. But risk doesn't disappear, it just migrates. They moved the filth to non-bank lenders, a $4 trillion ghost system that operates in the dark. These are the private credit funds that are now lending to companies that the banks won't touch. The leverage hasn't vanished, it just changed its name and went underground. This is a loophole wide enough to swallow a civilization. While the regulated banks look clean, the structural rot is festering right next door. These private loans aren't marked to market, they don't have to report their losses every day. This creates a pressure cooker effect. The steam builds and builds, hidden from public view, until the vessel simply cannot hold another pound of stress. We are one major corporate default away from a liquidity event that no one saw coming because no one was allowed to look. History does not repeat, but it rhymes in a minor key. Look back at 1929. The public was told we had reached a permanently high plateau. The engine then was margin trading cheap credit for the masses that allowed them to buy stocks with money they didn't have. Today, the mechanism is volatility targeting and carry trades for the institutions. These are the modern-day margin calls. In 1929, the market stayed irrational for 2 years after the fundamentals died. It waited until the last skeptic was silenced. It waited until everyone, from the taxi driver to the tycoon, was fully in. Only then did the ground open up. We are seeing that same exhaustion of the skeptics today. We are currently in the numb phase. This is the most dangerous part of the cycle. Bad news arrives, layoffs, debt defaults, war, and the market barely flinches. The curiosity watcher sees this as strength. The pattern recognizer sees it as anesthesia. The market has lost its ability to feel pain because it is being kept on life support by a government that is terrified of the alternative. The crash is Q, not canceled. When the break comes, the rescue will not be for you. The institutions too big to fail will be fed with your purchasing power through more debasement. This is the structural truth of modern finance. The system is designed to socialize the losses and privatize the gains. So, how do you inhabit a landscape of paper wealth without becoming paper yourself? First, recognize the cash trap. Holding paper is a guaranteed slow-motion robbery. The dollar is not a store of value. It is a melting ice cube. If you hold cash, you are a creditor to a bankrupt state. Second, seek the real. Own that which cannot be summoned out of thin air by a committee, land that produces, businesses that solve real-world problems, or scarce commodities. This is the hard asset shield. These are things that do not rely on the solvency of a counterparty. Third, maintain dry powder. Wealth is not made in the boom, it is harvested in the bust. In 1930, while the world wept, those with liquidity bought the future for pennies. When the forced liquidation begins, when the passive engine turns on its creators, the opportunities will be generational. But you must have the courage to wait. Fourth, understand the friction of debt. In an era of rising rates and slowing growth, debt is no longer a tool, it is a shackle. Those who are leveraged will be the first to be liquidated. Those who are unburdened will be the ones who decide the price of the new world. You cannot expand paper claims forever without a reckoning. Physics is patient, but it is absolute. You cannot build a $60 trillion skyscraper on a $30 trillion foundation without the wind eventually finding the flaw. The market has not crashed because the delay is being paid for by your future. The pattern is visible. The indicators are red. Your only job is to believe your own eyes.